understands what our policy is attempting to do, to be clear what our objectives are and what steps we're willing to take to meet those objectives. Ultimately, if
that's been Bernanke talking about short-term inflation. We're doing a live video, so MMTs, just listen up, and you'll be taught. Watch the tape as well, the buy and sell side tape, because everyone wants to hear exactly what he's going to do. But MMT Bill said he was saying a lot of stuff with no substance to it. So I'm going to put the inflation part on right here, expectations.
Successful economy, and we will do what's necessary to ensure that that happens.
Mr. Chairman, job creation and rates on mortgages and other loans when the Fed ends its $600 billion bond buying program. And a quick follow-up is, will the Fed how long will the Fed continue to allow for reinvestments? Thank you.
As I've noted, and as you're all aware, we are the program at the end of the second quarter, $600 billion. We are going to do that pretty much without tapering. We're just going to let the purchases end. Our view is that, based on past experience and based on our analysis, is that the end of the program is unlikely to have significant effects on financial markets or on the economy. The reason being that, first, just a simple point that we hope that we have telegraphed today, we hope we have communicated what we're planning to do, and the markets have well anticipated this step, and you would expect that policy steps which are well anticipated by the market would have relatively small effects, because whatever effects they're going to have would have already been capitalized in the financial markets. Secondly, we subscribe generally to what we call here the stock view of the effects of securities purchases, which by which I mean that what matters primarily for interest rates, stock prices, and so on, is not the pace of ongoing purchase, but rather the size of the portfolio that the Federal Reserve holds. And so when we complete the program, as you noted, we are going to continue to reinvest maturing securities, both treasuries and MBS, and so the amount of securities that we hold will remain approximately constant. Therefore, we shouldn't expect any major effect of that. Put another way, the amount of ease, monetary policy easing, should essentially remain constant going forward from June. At some point, presumably early in our exit process, we will, I suspect, based on conversations we've been having around the FOMC table, it's very likely that an early step would be to stop reinvesting all or part of the securities which are maturing. But take note that that step, although a relatively modest step, does constitute a policy tightening, because it would be lowering the size of our balance sheet, and therefore would be expected to essentially tighten financial conditions. That being said, we therefore have to make that decision based on the outlook, based on our view of how sustainable the recovery is and what the condition of the situation is with respect to inflation. So we will base that decision on the evolving outlook. It depends on the outlook. The committee will have to make a judgment.
Is it in the Fed's power to reduce the rate of unemployment more quickly? How would you do that, and why are you not doing it?
Well, I should say, first of all, that in terms of trying to help this economy stabilize and then recover, the Federal Reserve has undertaken extraordinary measures. Those include, obviously, all the steps we took to stabilize the financial system during the crisis. Again, many of which were extraordinary measures taken under extreme circumstances. Even beyond the steps we took to stabilize the system, we have created new ways to ease monetary policy. We've brought the federal funds rate target close to zero. We have used forward guidance in our language to affect expectations of policy changes. And of course, as everyone knows, we have now been through 2 rounds of purchases of longer-term securities, which have seemed to have been effective in easing financial conditions and therefore providing support for recovery and for employment. Going forward, we'll have to continue to make judgments about whether additional steps are warranted, but as we do so, we have to keep in mind that we do have a dual mandate, that we do have to worry about both the rate of growth, but also the inflation rate. And as I was indicating earlier, I think that even purely from an employment perspective, that if inflation were to become unmoored, inflation expectations were to rise significantly, that the cost of that in terms of employment loss in the future, as we had to respond to that, would be quite significant. And so we do have to make sure that we are paying adequate attention to both sides of our mandate. But clearly it is the case that we have done extraordinary things in order to try to help this economy recover.
John Itzty with NPR News. Mr. Chairman, it's the view of a lot of economists that the second round of quantitative easing hasn't done much to help the economy. What positive effects can you point to directly? And if there are positive effects, can you really afford to end the program in June with the unemployment rate still around 9%?
Thank you. Well, first, I do believe that the second round of securities purchases was effective. We saw that first in the financial markets. The way monetary policy always works is by easing financial conditions, and we saw increases in stock prices. We saw reduced spreads in credit markets. We saw reduced volatility. We saw all the changes in financial markets, and quite significant changes, that one would expect if one was doing an ordinary easing of policy via a reduced federal funds rate. And indeed, we saw the same types of financial market responses in the first round, which began in March of 2009. So we were able to get the financial easing that we were trying to get. We did get very significant easing from this program. You would expect, based on decades of experience, that easing financial conditions would lead to better economic conditions, and I think the evidence is consistent with that as well. As I discussed.
Okay, MMTs, that was very important as to what was going on right there. A lot of what I'm hearing is a lot of double talk. Yes, these things do work for a period of time. However, you have to know when to pull the stimulus out of the system. And when they talk about buying up the stuff that they're buying up, hell, for all we know, they could have bought the whole stock market in this last 24-month bull trend at the bottoms and can sell those assets back now. I don't put anything past any of them, especially when it comes to capitalism. However, I'm going to conclude part 2 MMTs. We'll have a discussion on it later, and I'll start part 3 to some. I think there may be a couple more questions. The questions that have been asked, I'll answer them with you as to what it means and what is the pro, what is the con, and what kind of data set tools, SMF tools, do we use to decipher it.